Most investors think building a strong portfolio requires 15 funds, constant monitoring, and complicated strategy. It doesn't. In fact, complexity is one of the biggest threats to long-term returns. Good morning. Today I'm going to show you how to build a simple four-fund portfolio that actually works, not flashy, not trendy, but durable. Here's the foundation. A strong portfolio needs four things: growth, broad exposure, stability, income. That's it. Let's break this down. Fund number one, broad market exposure. This is your foundation. An S&P 500 ETF or total market ETF. This gives you exposure to hundreds or thousands of companies. It captures overall economic growth. This should be the core of your portfolio. Simple, efficient, low cost. Fund number two, international exposure. Many investors ignore this, but global diversification matters. An international ETF spreads exposure outside the U.S., different economies, different cycles. You don't need heavy allocation, just balance. This reduces single country concentration risk. Fund number three, stability layer. This could be a bond ETF or a more defensive income-focused fund. This isn't for excitement, it's for shock absorption. When stocks drop, this layer reduces volatility, and volatility reduction protects behavior. Behavior protection protects compounding. Fund number 4, Defenji, income or real asset. Exposure, this could be dividend-focused ETF or REIT ETF. This adds income generation and diversification beyond pure growth. It builds cash flow potential over time. Here's the midpoint reality. You don't need 12 funds, you need balance. Many investors complicate portfolios trying to feel sophisticated, but sophistication without clarity leads to overlap. Overlap increases concentration. Concentration increases fragility. This fourth fund structure reduces fragility. Now let's talk allocation. There's no universal perfect split, but a simple framework might look like 50-60% broad market, 10-20% international, 10-25% stability, 15% income. Real assets adjust based on age and risk tolerance. Younger investors may tilt heavier toward growth. Older investors may tilt heavier toward stability and income, but the structure remains the same. Here's why this works. It captures growth. It spreads risk, it reduces volatility, it creates income, and most importantly, it's easy to maintain. Once built, you rebalance periodically. You don't tinker monthly. You don't chase headlines. You maintain structure. Let me ask you something. If you had to explain your portfolio in one sentence right now, could you? If not, it may be too complex. Simplicity builds discipline. Discipline builds wealth. You don't need to outsmart the market. You need to survive it consistently. 4 funds, clear structure, intentional allocation. That's enough. If this simplified things for you, subscribe, because strong investing isn't complicated. It's structured.